in acquiring the land. For example, legal fees paid, agent fees that you paid to locate the property, government taxes, right? And also the cost of the land value that you paid. So these are all included in cost of land. We will also talk about when we talk about how we basically account for land, right? I'm just giving you a taste right now. So all these information, they are recorded in land and land account, and land account is our asset account. And the building, similarly, building, cost of building, right? If you are acquiring a building, so all those agents fees that you paid, right? Any kind of repairment, maintenance, that before you actually move into this building, so you make it ready for your business. So all those repair and maintenance, for example, whitewashing, applying fence, security cameras, this kind of stuff, all belongs to the building account. That transaction will go to the building account, and building account is our asset. Specifically, which kind of asset? This is our long-term asset or fixed asset. Equipment, fixture, and furniture. So these are also fixture, means that are, for example, AC that is fixed on the wall, right? This kind of stuff, the wall clock, TVs, big screens, this kind of stuff, projectors, these are fixtures. Equipment, different kind of equipment. For example, we have coffee machines and this kind of related printers, it's like that. Furniture, like chairs, tables. So all those cost of furniture, what do we mean by cost of furniture? The delivery fees also included in cost of furniture. For example, you purchase the furniture for $10,000, but shipping all that furniture into our building requires $2,000 of delivery charges. So our cost of furniture would be $12,000. So all those, expenses are recorded in equipment, fixture, and furniture account, and that account will be our asset account. Similarly, liability, which is our debt, and what we call liabilities are outsiders claim. And what are liabilities account? Accounts payable. And what we call the account payable, these are our supplier account. So it means we are promising our suppliers we are paying their money back. So this is a kind of debt that we want to pay. But normally account payable, you can also remember that these are our suppliers. We want to pay them money, right? Notes payable, similarly, suppliers can say that you will pay us, this money after 3 months, 4 months. I would be, if I deposit this money to the bank, I would be receiving this much interest rate. So consider this period as a loan period, and when you pay me the amount, give me some interest as well. So the difference between account payable and note payable is interest paid. In notes receivable, you receive the interest. In notes payable, you pay the interest. Okay. Accrued liabilities, like prepaid expense. So these are liabilities that occurred but not paid. This is the opposite of prepaid account. In prepaid account, expense not occurred but you pay in advance. In case of liabilities, accrued liabilities occurred. For example, salaries occurred but you didn't pay. Similarly, you give the maintenance work is done but you didn't pay. Tax liabilities, similarly, tax occurred but you didn't pay. We call this accrued liabilities. And then shareholders account, we have common stock, retained earnings, dividends. I'm not going to waste too much time here. We already talked extensively what do we mean by all these three. So here we go. Common stock, These are owners' investment in the form of stocks, retained earnings, all those earnings that we earned over the period of time, but we didn't share with our owners, and dividends, it is the distribution to the stockholders, right? So one thing that is dividend is not pre-declared, it is declared by board of directors in annual general meeting. So they decide whether this year we want to pay or not, or how much we want to pay. Okay, now as revenues and expenses. So remember, revenues and expenses both belongs to shareholder, because company belong to shareholder and company is set up for its operation, and its operation is to sell the goods. And when you sell it, look at all this revenue. So when you support your selling, it means all the cost that you incurred for selling the goods becomes your expenses. So revenue and expenses belong to company. So we have the company account, that is stockholders account, owners account, right? So remember, the new thing we are learning here is that revenues and expenses belong to shareholders equity. So in case of our accounting equation, assets is equal to liabilities plus owners equity. So in owners equity, we have common stock, we have retained earning, we have dividend, we have revenue or sales, and then we have expenses, right? So revenue means increase in stockholders' equity from delivering goods or services to the customers. Expenses means that these are the decrease in stockholders' equity due to a cost of operating the business, right? Or the other definition is that these are the decrease in, these are the costs that we are incurring to support or to enhance our sales. Basically, ultimately the goal is to increase the sales and to maximize the difference between revenues and expenses so that we can have bigger profit. Any question? If you don't have any question, then please answer this. So name two things that increase wholesale food market in corporation stockholders equity. So this is a company that deals with the food, and you need to just think about that. Two things that increase its stockholders equity. Anyone?
Sales of the food.
You can buy back your shares.
Increase. First we talk about increase. You said sales.
Retained earnings and owners equity, the common stocks.
Can you repeat?
Retained earnings and common stocks.
Very nice, but retain earning what? Increase in retain earning or decrease in retain earning?
Increase retained earnings.
Increase in retained earning would be increasing shareholder equity. Increase sales already. When we have a sales, it increases the stockholder equity. Anything else?
You can buy back shares. Will that also be?
If you buy back shares, it will decrease the stockholder, because buyback shares are called treasury shares, and they are written in negative form.
Okay.
Okay. Issue of shares, common stock. Increase in common stock would be increasing the shareholder equity, and decreasing shareholder equity. Decreasing shareholder equity.
Pay for the salaries.
Exactly. Increase in expenses all kind of expenses, increase in rent, increase in salaries, increase in maintenance, whatsoever that belongs to your expense, that will decrease shareholder equity, that is increase shareholder equity. Any other point here? So you can say, first of all, you classify or write down the categories of stockholder equity, and you can find out easily what decreases the shareholder equity and what increases the shareholder equity. The second point is dividend. If you increase more dividend, the shareholder equity decreases. Right? So let's see our answer here. Increase sales, increase in income also increases the shareholder equity. And our decrease, which means dividend or loss, how loss occurs if expenses start increasing. So any question up till now? Okay, now we are.
Yeah, how is buying back shares? How does that decrease common stock and then therefore stockholders' equity?
Okay, first of all, buying back shares. If I'm talking about buying back, it means we are talking about buying back your company own shares, right? Or others' company shares. If others' company share, then you just say that buying shares of other companies or short-term investments. You can say that. But that is your assets, not your shareholder equity. But buying back your own company shares, that belongs to shareholder equity. It means you are, for example, you issued 100,000 shares as a common stock, and now 50,000 you buy back. Now what's going on here? You buy back, it means you decreases. The name is called treasury stock. You decreases our common stock. So look at the structure of shareholder equity. Number one, stockholder common stock, and then retained earning, and then dividend, and sales and expenses. So you see, common stock will be decreased.
You buy. Why is it minus 50,000 to you? If you own the 100,000 shares, and if you buy if you sell them, I get it, right? Because you're selling them for
So
money.
here we go. Assets is equal to liabilities plus owner's equity, right?
Right.
And
Okay.
in owner's equity, what we have? Common stock, we have retained
Mhm.
earning, we have dividend, and we have revenue and expenses, right? In assets, for example, we have right now different. So what happened right now? You issued share of 10,000 with one each. So one share price is $1. So you receive cash, right?
Mhm.
Understand?
Yes.
And now you buy back shares, $50,000. You buy back, it means you pay cash to those who own the shares, right?
Right. Oh, so you decrease
50,000.
because it decreases cash
It is the decrease in common stock as well,
and it's common stock as well. Okay.
right? And now our balance would be 50,000 left cash and 50,000 our common stock. So look at shareholder equity. It increases or decreases?
Decreases.
Now you get it?
Yeah.